Hi, I'm Kals, and welcome to The Comparable, the series in which each episode spotlights two companies building similarly in two different emerging markets. For this episode, we're highlighting two companies that are leading B2B e-commerce platforms in their respective markets. OmniRetail operating in West Africa and Chipper operating in Latin America. In emerging markets, B2B or business-to-business e-commerce platforms service the millions of small retailers and corner shops that power many of these economies. In Africa, the informal retail sector accounts for about 90% of transactions in Nigeria, 96% in Ghana, and 70% in Kenya. In Latin America, there are over 3.7 million corner stores, or these mom and pop shops, that generate an annual revenue of $330 billion. While these small businesses account for a tremendous amount of transactions and commerce in these markets, these small business owners face a number of challenges in staying competitive, with major inefficiencies including fragmented distribution networks, limited access to working capital, unreliable logistics, and a lack of transparency in their supply chain. Digital platforms and marketplaces rose as a way to solve for these inefficiencies, digitizing and streamlining interactions among manufacturers, distributors, and retailers, allowing them to buy and sell goods and services to one another online instead of through traditional offline channels. These platforms streamline procurement, logistics, and payments, connecting informal and formal retailers more directly with brands, large suppliers, and manufacturers. In an ideal world, the process removes intermediaries, reduces costs, improves efficiency, and often provides additional services such as delivery and credit. We saw a number of notable platforms come up across emerging markets in the past 6 or 7 years, and the sector attracted a lot of capital, especially during the period when interest rates were low and VC funds globally were investing a lot more money in emerging markets. In 2021, B2B e-commerce plays attracted a peak of $7.1 billion, second only to the fintech space. As global VC activity slowed down, the sector attracted a lot less capital, with investors finding capital-intensive businesses, which B2B e-commerce platforms can be, overall less attractive. For this episode, I wanted to highlight OmniRetail and Chipper not only as two examples of leading players in their respective markets, but also as two platforms that were asset light from day one and have showcased resilience and adaptability with the highs and lows of the past 5 years. OmniRetail, founded by Dipankar Rostlagi in 2019, was named Africa's fastest growing company by the Financial Times in both 2024 and 2025. They've raised about $38 million in equity and debt since their inception. Chipper, founded in 2018 in Colombia by Jose Bonilla, Oscar Guerrero, and Carolina Garcia, started as a platform and has evolved to become more of a software play, an operating system for retailers across Latin America. They've raised over $78 million to date. Lots to dig into in our episode with Omni's founder, Dipankar, and Chipper's co-founder, Jose, so let's get into it. My guests today are redefining and transforming how traditional retailers build and grow their businesses in their respective markets. Dipankar Rostlagi is the founder and CEO of OmniRetail, which has evolved from a straightforward B2B ordering platform when they launched in 2019 to a comprehensive retail infrastructure provider combining commerce, logistics, and embedded finance today. They operate across Nigeria, Ghana, and the Ivory Coast. Jose Bonilla is the CEO and co-founder of Chipper, the leading B2B e-commerce platform in Latin America that digitizes the entire procurement process for retailers, which was launched in 2018. Today, Chipper OS is an operating system that includes AI-powered ordering, intelligent inventory control, and real-time analytics for both stores and suppliers. They operate in Colombia, Mexico, Brazil, Chile, and Venezuela. So lots to dig in our conversations about scale, being asset light, lots of stuff here. So welcome to both of you. Dipankar, my first question is for you. OmniRetail, you guys reportedly achieved EBITDA profitability in 2023 and net profitability in 2024, processing over $810 million in transactions in 2024 while achieving 40% year-over-year revenue growth, which is no small feat. So congrats on that. I noticed that, when OmniRetail has talked about publicly, you guys don't even report GMV numbers. So top line is no longer something that is even reported for you guys, which, when you think about B2B e-commerce in the past, that is actually what people talked about. So for me, that is actually a sign and a signal of kind of a focus that you guys have on that bottom line and kind of emphasizing it more than top line. But I'm curious about whether this was always your focus from day one, and how have you guys evolved from those early days in 2019 to today?
Thank you for that. Yeah, so to give you a little background, I'm a second-time founder. This is the first platform that we built was called Reconnect. It was a platform that provided services to small businesses in Nigeria, and in 2019 we started OmniRetail. From day one, we were very clear we are not going to get into manufacturing our own products. We are going to enable the different stakeholders in the value chain to achieve more through digitization of the value chain. And knowing this clearly helped us focus on not looking at what is the GMV, because you could sell a lot of commodities at negligible margin and at negligible value addition and make very high margin, I mean, very high GMV, but might not get profitable even with a very large value. So we were very clear we need to focus on where we can add value, which are the products that are more difficult to distribute. It might not be a rice or a sugar or a salt. It might be packaged products where brands want more reach, want more numeric distribution, want to engage with customers, and digitizing the value chain for them will be beneficial. So from day one, we were conscious that if we look at what is our revenue, which is the incremental value we create in distributing products, that's what we should focus on, and that'll help us stick to achieving profitabilities faster.
It's great, and would love to, hear a little bit about that evolution for you as well, right? Because obviously started more kind of as, thinking about it more from the e-commerce platform standpoint, and then, obviously launching OmniPay and all of that. So just curious about how you started to build and add on and the evolution of you guys over the years.
Yeah, I mean, over the years, what we have realized in the journey is it was never about a perfect idea. It was always about persistence and creating value to your for your end customer. So when we started as commerce, the value was easy for people to understand that this is the product that you will receive in your store. You don't have its convenience. You don't have to haggle or negotiate or find the product in the open markets. So that's how we started, which was easy for people to understand. But over a period of time, we realized it's a digital infrastructure play where financial services plays a very important role. There are various places where without financial services, reordering, retention, growth of customers can't really be reached. And that was a gap because of which commercial financial institutions were not providing services to this particular layer in the ecosystem. So we understood that, we went deep into it, and we realized it is not just going to be a very successful impact on our end consumer customer if we provide just commerce. We need to ensure for their growth, it's commerce, it's financial services, and it's data and algorithms helping them do more with the resources available. That's how we grew.
Jose, I think you guys have had a very similar customer centric approach with Chipper over the years. You evolved from initial product market fit and scale when you guys launched in Colombia in 2018. Then you launched in Mexico. You started scaling to other markets like Brazil after your Series B during that kind of like 2021, 2022, like that hype of lots of money flowing into this space. But in 2023, you rebranded to Chipper OS, an operating system for independent distributors, as I mentioned before, that leverages AI-driven order management, intelligent inventory control, and next day delivery. So kind of a bit of a software play. And I would love to see about, it seems your focus is also on this drive towards that profitability. You've talked about that in recent interviews as well. Can you talk more about your evolution over the last 7 years that you guys have been around, and what have been the biggest challenges and learnings that you've had in that time?
For sure. So we began in 2018 selling short-dated products, that were like close to expire, and we basically a company offered us the opportunity to start selling those products because those products were basically well, they were thrown to the trash, and there was value there. So that was like the starting point, very different to what we do today. If you go to 7 years behind is like, okay, how these guys got to this from that. So we've been used on how not how to approach very openly to the problems that you're going to find on an industry, and start finding your way. The second step that we took was, okay, these products, like they have basically a cap for growth. We cannot bring like many categories to offer a wider assortment to our customers. So we need to start talking to basically other manufacturers and try to offer a wider assortment, because our customers at our corner stores are asking for more. It's not enough just with one category. They need more. So we start talking to other manufacturers, and that was the second step of Cheaper, where we decided, okay, we're going to have almost everything, not everything, because we didn't have like products like that required cold chain, for example. But we brought most of FMCG categories to the platform and start offering on the platform these products, and building the software to be able to operate commerce for businesses. That is very different than a P2C e-commerce company like Rappi or DoorDash. They have other type of dynamics. We have to procure products from manufacturers, store them on the warehouse, take care of the inventory, get orders ready. So we start building the platform for this. We couldn't find software that was like what we needed to offer next day delivery, to handle 2,000 products. The solutions were not there. So basically, because we needed, we start building that technology. And then the third step that was like very natural was a distributor telling us, hey guys, we need what you have built. We need your software. And we are in Chile. That was the first time that we offered our platform as a service, because we couldn't go there and open the operations like we did in other markets. It was not part of the plan. We didn't have the money to do that. So we said, okay, like, why not? Let's offer them, like, let's price how we're going to charge them for using our platform. And yeah, why not? If it works for us, it probably could work for someone else, no? And that was the first time that we did this software solution or platform as a service for a third-party distributor that was paying us a commission fee and more software-based solutions using our software. So that's basically how we evolved during these 7 years. Most of the steps that we took were not like us thinking about the next strategical decision of where we're going. It was more hearing the things that people were telling us, our customers, distributors, manufacturers, like, be very open to hear what they need. Obviously, we cannot solve everything, but we picked a couple of things along the years that evolved Cheaper to something else. And then in the end, after this Chilean experiment that went really well for us, really well for them, and other inputs from the market, for raising like tons of capital to open new markets was going to be very hard. And these type of businesses require a lot of capital because you have inventory, you have a distribution process behind that is very complex and very expensive. We said, okay, this is an avenue that we can take for growth. We can scale faster. Let's price this a bit better, because the first time was just like kind of an experiment to try to offer this to other distributors. And then after like making this decision, now Cheaper is looking forward, working together, still with customers, like independent businesses that use our marketplace and the solutions that we have there for them, but now partnering with distributors anywhere in Latin America that need our platform to basically, let's say, modernize their operation, modernize their processes, have more control, better data,
both of you guys have kind of been around in like the right before like all that international VC money started like being thrown at these markets, and specifically B2B e-commerce outside of fintech in like 2021, 2022 was probably the sector that attracted the most amount of capital. I operate in Buxton. That was literally, we had like 5 plays that came up literally around the same time, worth a ton of VC outside of international VC money that was flowing in. But I also think that now as like, capital scarcity is happening, we have a lot of macro issues in most of our markets right now. In the markets that you guys are both operating in, VCs are a lot more wary as like time has happened and realize like these are actually very complex businesses and really hard to get right. As you mentioned, the bunker, like margins can be really slim. So it's easy to kind of not be profitable. And I'm curious for you, and maybe Jose, if you want to go first, what do you think most B2B e-commerce plays, but also VCs, what do you think they got wrong during this period? And not to like call anybody out, right? But even mistakes that you guys might have made yourselves. Like it was easy in that kind of time to get swept up because there was so much capital. It can be a very capital intensive business. But what do you think looking back, like most people got wrong about the space, and how do you see it evolving today, right? In the time period that we're in?
Thank you for that question. I I wouldn't say that VCs or entrepreneurs did something wrong or didn't get something about the industry or the business. As the banker says, everyone knows how complex distribution business is. Everyone knows that requires a lot of capital if you want to build a like tech-enabled distribution company. Same thing for a B2C company as Rappi or DoorDash. Those businesses haven't been built with a few $1,000,000. They have raised billions of dollars, and they have burned billions along the years to get where they are. So e-commerce is a very, very expensive play. And I'm pretty sure every VC knows that's a reality that they would face also on the B2B side. I think what other than having something wrong, I think the main challenge and the main, say, the most important decision that every entrepreneur has to take is how they evolve for their company to survive and thrive. And I think not making that decision on time, or not having probably the opportunity, or they didn't solve how to get to the next stage of their business, where the business can still be a big business, can still grow, have like a huge market ahead, and also can leverage on what they have built already. That's like the ingredients to make a decision. Then the decision could be like us, just someone else telling us, "Hey guys, I need your platform." Like it wasn't something we were thinking about. Just thank you for this offering. Let's do it because we believe that makes sense. And then it becomes cheaper for the future. So I think other than having wrong something, it's being very open and hearing a lot what's happening in the market, like even macro situations that could not be exactly happening on your country, but are happening in the world, and you need to be aware of them. Hearing your customers, and in the end, okay, what's my next step? If cheaper was the same thing that it was in 2018, it would be dead already years ago. If cheaper was today what we were in 2021, 2022, it would be dead already. So it's kind of, I think the lesson and probably people that has been forced to shut down their companies, it could be more related to they didn't have the chance to make a decision for the next step of the company to keep surviving first and then thriving their company to something bigger.
That's all great points. Debunker, did you want to add to that?
Yes. I think this is a very interesting question, and it's also a problem today. So today, when you go to someone to engage and talk about B2B commerce, majority of the investors have these sour stories from their past, which they don't want to reflect back at. And I feel no one consciously made a mistake, but certain things did go wrong, both from startup side, investor side, some assumptions that were not laid right. were around what exactly are we going to invest in. And like Jose mentioned, they saw the Amazons and the DoorDash and more B2C centric models. Investments went into recreating the infrastructure on the B2B side. And these are large markets where actually there are definite number of customers. But instead of engaging with the customer, educating the customer, aligning the incentives, and structuring the market, recreating infrastructure, I think, was a mistake. And a lot of companies went ahead and invested significant pools of capital in that. And supply chain is not really like blockchain. It's not really a technology that you operate just from your computer. It's more about actually moving things on the ground and requires a larger learning curve. So I think in the whole discussion around asset heavy, asset light, centralized model or a decentralized model in a B2B sense, I think that was one thing where assumptions went wrong, investing into infrastructure and expecting a quick return. The other part, which we've spoken about, is expecting the margins to be larger in a digitized B2B commerce. So, yes, there were low margins when it was a traditional B2B commerce uh, everywhere, but expecting because it's going to be digitized, the margins will be better and tomorrow we will be profitable. Didn't I mean, on the consumer side, it's a different scenario. You break the cartons, you have demand. The the value addition for creating demand is much larger. In B2B, demand creation is not that big a factor because it's repeat demand factor. So I think that was also an important point. So assuming that tomorrow is going to be better, it also dependent on markets. So markets like India, Pakistan, Nigeria, Indonesia, and I'm sure Jose will be similar in Mexico. We don't have the sort of capital which United States or some of the other evolved venture capital markets had. So you can't invest for 10, 12, 15 years. We have external factors which change for these markets and capital goes dry. So then you are completely dependent, your business is completely dependent on external factors. If you don't get the same amount of capital again and again for the next three rounds, you might not be able to make it. So I think that was an assumption that, like the capital availability in more developed VC markets, there is going to be capital in Nigeria or in Africa, in other markets, which didn't play well. People got We all got very we were welcomed really well by venture capitalists, but after a certain time when external factors changed, overnight profitability except expectations were there, which was not easy for many companies to live up to.
I want to talk a little bit about growth and scale for both of you, because I think oftentimes, I think one of the big misconceptions of both every single one of these regions in these markets is that we treat them like monoliths, right? We think about Africa as, a country rather than a continent with so much nuance. Same with LATAM. And, Jose, I was listening to an interview that you talked about the growth of Chipper, and you didn't talk about it as a market growth. You talked about it as like cities within Colombia, or like even just now we were talking about it, right? And I think there's so much nuance even within these markets themselves. And I would love to understand a little bit more from both of you. OmniRetail, you guys currently operate in Nigeria and Ghana, but you just recently, entered Francophone West Africa, which has its own beast, right? Of what that means in the Ivory Coast. Chipper, as we mentioned, operates in 5 markets in Latin America: Brazil, Colombia, Mexico, Chile, and Venezuela. So I'd love, maybe the bunker first, and you, Jose, how do you both manage an already operationally complex model across these different geographies and markets, and what dictates where you go and why?
Yeah, I think growth and expansion is a very important part. Exactly where do you want to invest when you haven't proven your unit economics in one market and you have to take the bet to go to more markets? It's a question of belief in yourself, belief in your people's belief in you, and also your partner's belief in you. So I think getting it right in one market was super important for us. And then as we started getting it right, we saw our people, that means there were teams that were interested in expanding into different local markets within Nigeria. Even though it is one country, it is a pretty large country with a lot of diversity. expanding in the northern Nigeria, which is a Hausa market, and different from the southeast of Nigeria. I think what we were lucky at in doing it well, we were able to attract partners. The market we started with, which is Lagos, the commercial capital of Nigeria, enabled us to experiment with large manufacturers and solve their problems in distribution in this market. And during our expansion journey, we could partner with these manufacturers, give them the data that they needed to give them the visibility of products, build tools for shelf space, build tools for efficiency of team, which was valuable for them. And rolling those partnerships out, uh, from a central operating system perspective, like Chipper has built, was what worked for us. So when we were going into other markets in Nigeria, or when we were going into Ghana, we were actually not depending on our strength independently. We were also depending on the strengths of our partners who have been operating in those markets and who understood our technology strength operating with us in Nigeria. So we were trying to live up with their strengths in the operation side and expanding. So, and I think Francophone also was not a decision which was in a board meeting that, hey, we are going to go into Francophone West Africa. It was more about three partners have approached us. This is the size of their business. This is the total reach they have. This is the distribution number of points of sale they have. If we deploy our solution, we will be able to add value to these many retailers in those markets. And soon we're looking at expanding with the similar partners in other markets in West Africa. So it's more around partnership and people that we took the call on the expansion.
Is there a particular DNA to West Africa that rather than you going to like East Africa necessarily or like go to Kenya, is there a DNA of in West Africa or a nuance to it that is why you've kind of been focused on that region?
Absolutely. And I would share here that we actually did go to East Africa. We went to Kenya. That was our first market outside of Nigeria. And it was great learnings. And that's why I so specifically emphasize on partners. The structure of the market and the margin structures in those markets are very important for you to attract the right partners. East Africa as a market has its own strength. Distribution is more evolved. It's more agri dependent. They have exports of fruits and flowers. Warehousing and logistics infrastructure is built, and there are smaller manufacturers in each part. These manufacturers play a larger role in the value chain. Some of them have their own distribution companies, so their own distributors across different parts of the country. So margin expectation, because the volumes are smaller, these manufacturers are making much larger margins, and they don't want to depend on anyone else for their distribution because these are smaller, comparatively smaller countries. So when we went to Kenya, we realized it's a very different structure. It's a very different culture. It's a very different margin structure, and we were happy to fail fast and realize and recognize where we failed, what decisions we didn't take right, and then we looked at the same points in West Africa. The markets were similar. Francophone has its differences, but it's still more than 75% traditional trade market.
Jose, I would love to hear similar journey for you guys in terms of growth and scale. I'm sure there were places that you guys grew to that you're like scale back from. And also there's so much nuance within Latin America. It's such a massive continent. How did you guys think about that for yourselves?
Yeah, so we learned a lot from this complexity of operations in different markets by having a tech-enabled distribution that we were responsible for, like end-to-end process, and because of that, obviously our business right now is much simpler. We work with distributors in every market that we are. So for us, it has simplified, but we understand the complexity that distributors that are our customers are facing in every market. And well, the way to the question in how we manage this complexity, let's say first, lessons learned obviously are applied to everything that we offer to distributors. We understand their fears to change. We understand their processes. We understand how they work because we have done it ourselves. And I think that gives us a lot of empathy when we are working together to help them to become better distributors and provide a better service for their customers that are corner stores. So we work very closely to distributors, to corner stores, to manufacturers every day, trying to understand what are the differences that they are having in each market. If you go to Venezuela, it's a very complex issue to price products, for example, because prices changes every day, and that's like for them a huge challenge. Not for Colombian distributors. The prices in Colombia might change once a month, a couple of times per month, not for every SKU. So like we are always trying to understand, okay, how each of these different markets and regions work. What are the differences that they have, not only because of the political situation, but also in particular neighborhoods. For example, in Brazil, basically you cannot enter and sell products in cash on delivery. You have to use Pix, only Pix. So we need to build technology so that they can differentiate, like even a small neighborhood, where they just don't receive cash. All the routing process is different than the usual routing process for a truck that is going to a neighborhood without this type of issues. So yeah, we're constantly talking to all of them. Fortunately, the core problem is the same, and we focus obviously in solving or as well as possible the core problem, but then building solutions that are easy to be flexible for each of these partners to be able to adapt to the conditions that they have, and that's how we manage complexity today. That again, for us, in terms of operational challenges, we don't have the challenge that we had in the past, managing inventory, delivery, like customer support, like a lot of things. We're building technology or improving the technology that we have to be able to help them to do a better job. And the second question about how we decide about markets, when we expanded to Mexico and Brazil, for us was taking a step to the largest markets in Latin America, and we want to have a presence there and try to build the company that was being successful in Colombia on these two markets that are basically where everyone would like to in Latin America to have a software company because of the size and of the opportunity that you have.
Because you mentioned you're operating in Venezuela, tons of, obviously from a macro standpoint, tons of currency fluctuations there. The longer we were talking about currency fluctuations in West Africa as well, Nigeria. Curious about, for you guys with the retailers that you work with, these corner shops, these small retailers, obviously they're tremendously impacted by these shocks economically. And how do you guys help them? Like keeping them both at the center, keeping that customer at the center of who you guys are. What are some examples of things that you've done to help them navigate some of the, things that have been happening in their respective environments? Maybe Jose first and Dipankar.
Yeah, I would say, Kachun, one of the most relevant examples of helping these businesses, independently of the market that they are or the conditions that they have, is being able to, for example, offering them online payment methods. Venezuela has the Venezuelan, like every industry has adapted to the conditions that they have with their currency. So they're using like alternative payment methods to the like Bolivar or cash, because sometimes some transactions could be like piles of cash to be able to pay for it. So what we have been doing is through our platform, connecting online payments, connecting credit entities that are willing to offer them working capital for businesses to be able to buy their products to distributors. So we have become kind of a bridge for payment and credit solutions to be able to get to the market and solve to these customers a problem that they have for access, because most of them, they don't have these opportunities of having credit because they don't have access to that, because they don't have like credit record or information enough for someone to score. We have it because of the transaction, so we can complement whatever information the credit entity is going to look for a specific customer. And secondly, giving a credit, for example, to a small corner store in the typical way of doing that, acquire the customer, going to the store physically to fill in the papers, then going and collect the money for each credit. That's very expensive for a $100 credit. It doesn't make sense. The business, just the economics doesn't work. But if I provide them through our APIs information for them to decide who they are going to provide credit to, and then they just give them a credit because they already have the information. The acquisition cost for them was like nothing, zero. And then if the credit is going to be paid through the payment network that we offered for the marketplace, then collecting the money is much easier and much more efficient for them to be able to provide credit and have a business that works for them. So yeah, we see ourselves for the market as a bridge for solutions that haven't had access before to corner stores to be able to get to those solutions and solve problems easily and seamlessly without having to spend a lot of time to be able to do it or a lot of money to be able to do it by the companies that offer these products.
Cool. Dipankar?
So let me give you an extent of what the devaluation in our currency has been. In the last 2 years, we went from approximately 400 naira to a dollar in 2023, 4 to 500 naira to a dollar, to a 1500, 1700 naira to a dollar.
That's worse than Pakistan, and I thought we were bad. So
yeah, I wanted to emphasize because a lot of us, our countries, we feel the devaluation in our country has been the worst. And this was in 9 months, we had election. And to top it all, just prior to devaluation, there was demonetization. There were changes in the currency and, implementing changes in currency in an economy which was predominantly cash based was crazy. We were blessed. We were lucky. Just prior to that, we launched our payment platform called OmniPay, and we started our collections end to end on that. Otherwise, it would be like Jose mentioned. We didn't plan for it, but continuous improvements have made it work for us. This is, if you would have asked us in 2019, would we do collections? Would we do lending for the market? Absolutely no. So this particular devaluation in the currency fluctuation for the retailer, what it meant in the short term, retailers were okay because their current inventory was being sold for higher price, and that short-term margin was welcome. But the reality was the long-term challenge was very big. Two major challenges. One was around their current working capital is not enough to buy the sort of inventory they were buying, forget the growth. And the second one was there was a huge shift in purchase trends. So people moved from buying certain premium products to buying less premium products. And as we all know, with that shift, there are reductions in margins. The margins in premium products are much higher. This was really challenging. We saw a lot of retailers close shops in that duration, and retail is one of the largest employment providers in the country. So, these are different points which connect together and make it worse for the economy. So these external challenges in traditional trade in our economies made it very, very difficult to consistently grow for traditional retail, and unavailability of working capital, unavailability of tools to empower them to see them through in these tough times is the challenge we are trying to break through. If we can be that platform where we can create an identity for each of the retailers, then we will find ways to provide them access to working capital, to provide them creditworthiness, and help them scale.
awesome. Sounds very similar from both of you in terms of how you're thinking about it. Just to end, curious, and just maybe one line on this so we can end on a high note. Maybe Jose first and then Dipankar. What is one thing, Jose, that is keeping you up at night right now? And what is one thing you're the most excited about?
The main challenge that we have right now as a company is launching our new platform. That is how we're looking forward is that we can provide a self-service platform for distributors. Right now, for us, being completely honest about how it works with a distributor, implementing solutions, it takes a lot of time. It takes a lot of work from our team together with their teams to be able to launch, for example, a routing model for them to start routing with our system and not using whatever they were using in the past. Or for them to move from their current sales agent app to move to our sales agent app. Those steps that commercially are agreed with the distributor, then making them happen takes a lot of time. And the platform that we are building right now, that is the new CheaperOS portal, where we are basically every day doing or launching new products, are expecting that we can offer this self-service platform where distributors can do 100% of the implementation process by themselves. Obviously, as usual, in the beginning, you will help them. You will be backing them on this process from whatever they are using right now to something new. And hopefully 5 years from now, any distributor in the world could just log into our platform and start selling online and then adopting our platform without the need of anybody to be behind. As I'm very excited about thinking how cheaper 5 years from now could become one of thousands of examples of how businesses evolve as they hear their customers and survive to the best moments in the world for raising money and the worst moments in the world for raising money, because we have been through one of the best moments in the world in the last probably 20 years to raise money. And we are going through one of the worst moments in the world for the last probably 20 years also to raise money, especially for businesses that were not conceived as AI businesses. We're conceived as something else, as a business. We use AI for solutions, for processes, but we are not building ChatGPT or Gemini or the things that investors want to put their money in today. We're building a business, and this is obviously a software business, and now has to adopt AI for the solutions that we offered. But looking forward, this company 5 years from now being able to be one of thousands of examples of, okay, look, this company went through all of this, and this is how they survive. That would be an amazing anecdote or example or business case for future entrepreneurs to be calm when things are great and you think that you are going to be a millionaire in a few years, but also keep that calm when there's no money and you have to become more creative.
Totally. This is why, for me, emerging market entrepreneurs are the most resilient entrepreneurs in the world for this reason. But I love that. Dipakar, do you want to also share?
No, absolutely. I think what keeps me up is balancing the growth of people with the growth of the business, providing them the education, the training, the understanding of how market is emerging. The people side of the business is what keeps me up. And super excited, like Jose mentioned, super excited about how use of data and artificial intelligence is reducing the gap in efficiency of the most developed retailers who have POSs and technology and better infrastructure with the traditional retailers, the mom and pop stores. So we are seeing artificial intelligence helping them with their data for better predictability, better understanding, better efficiency. And I think that's really exciting. Seeing these small retailers become more profitable excites me a lot.
This was such a great conversation, guys. So thank you both so much for making time today. I hope you connect offline and connect with each other, because I think there's a lot to talk about from both of your respective businesses. Thanks so much for being part of this. Thanks for joining us for this episode on B2B e-commerce that highlighted OmniRetail and Shipper. And while these playbooks are, a lot similar to each other, doing really interesting things, there's obviously so many other B2B e-commerce plays that are out there, different models that have adapted and shown resilience in this time. But hopefully you walk away from this episode really seeing founders that have thought through and have put their customers at the center of what they've done and really thought about the complexity and how to build for that, especially during hard times in their respective markets. So thank you for listening, for watching. Please subscribe on all your platforms. Share this if you like, and see you next time. Thanks. Bye.